So Simon, are you there?
I am indeed, Richard. Yes, good
Hi
morning.
Simon, how are you?
Good, thank you. Good.
Good, good. Yeah, so I think we'll do what we normally do with our special guests and have you just sort of run through what company's about, what you're trying to achieve, and then we'll get some questions in.
Great. Well, thanks very much. I've got a few slides just to sort of refresh people's knowledge of the business, the sort of thesis behind it, and what we've been doing since we IPO'd. So, good morning. My name is Simon Farnsworth. I'm the MD of Ironstone, the REIT's external investment advisor. Life Science REIT is the UK's only REIT focused on the life science sector. As I say, externally managed, and really having IPO'd in November 2021, we were oversubscribed at the time, raised 350 million, and successfully deployed all of those proceeds within our first 6 months of our operations. And absolutely key to us was having a portfolio of assets under exclusivity that we could acquire and deploy that capital quickly, which we did. And the portfolio today now comprises of 5 assets across Oxford, Cambridge, and London, and just over 500,000 square feet of life science space. And I'll come on to exactly what that means for investors shortly. So just flipping forward to the next slide, why the UK? Why the UK, particularly for life sciences? Well, we now have 5 of the world's top 10 universities for medicine in the UK. And in addition to that, it's well publicised what we've been seeing across the UK market over the last few years. Top level clinical research has to be near, in our view, academia and key teaching and research hospitals. And what is really clear through that is you get this collaboration, you create an ecosystem, you get a transfer of knowledge, ideas, and an evolution of science and creativity. And this is a well-established formula that came out of the clustering theory, and particularly out of Harvard and Boston, which is probably the global head of HQ, if you like, of life science in the world. But this is a really well-established formula now, and it's playing out really strongly in what people will know in the UK as the Golden Triangle between Oxford, Cambridge, and London. And specifically within London, we have an area called the Knowledge Quarter around St Pancras, King's Cross, and Bloomsbury. And this Golden Triangle across these 3 points, if you like, is globally recognised as an advanced top-tier life science cluster. It's the only one in Europe that's recognised as that. And it has large, world-class hospitals and universities. You've got Oxford, Cambridge, UCL, Imperial, and now King's has entered the top 10 in the world for medicine. You've got world-class teaching hospitals, UCH, the John Ratcliffe, Adam Brooks, strong corporate links, mature funding markets, and deep, affordable talent pools, which is absolutely key to occupiers and research facilities. And at the southern tip of the Golden Triangle, if you like, London's Knowledge Quarter, in my view, this is Europe's premier cluster. And this is, in a nutshell, what we call genius loci, if you like. Here you've got the Francis Crick Institute, you've got DeepMind, Google's AI business, you've got UCH and UCL, Great Ormond Street Hospital, the Alan Turing Institute. And it's no coincidence that MSD, formerly known as Merck, the global pharmaceutical company, looked all over Europe. Where are we going to put our new £1 billion R&D headquarters? And they've broken ground recently right opposite King's Cross Station. And in my view, this really encompasses what it's all about. Next slide, please. So life sciences, it's not all test tubes and Bunsen burners. It not only includes sort of pharma and healthcare now, but really involves a huge amount of data, technology, robotics, and even agri-tech. I mean, technology in particular is becoming key within life sciences, and it's every day you read in the papers. Even yesterday on the front page of the Times, there's a new dementia blood test that's been developed by Oxford University and University College Hospital and University College London. A great example of the sort of collaboration between businesses, academia, and research institutions within the Golden Triangle. Technology, as I say, is driving this. It's sort of almost turbocharging the pace of discovery and broadening the field of life sciences. There's a new industry term, deep biotech, which really is designed to cover areas like quantum computing and AI, and modern biotech, such as gene editing, gene therapy, which again, you'll read about nearly every day in the papers these days. And as you can see on this particular slide, this is really resulting in an influx of new investment into the sector by some of the world's largest tech companies. Traditionally, it's been quite a sector quite pump primed by VC and private equity. Interestingly, in 2023, UK venture capital investment was down 43% across the whole of the UK economy. Life sciences was pretty flat, down only 6%, which gives a really good indication of the sort of strong levels of investor interest in the underlying businesses. But here you can see, some seriously big tech players now branching into the sector, whether they're using their own AI or they're setting up their own drug discovery businesses. So very exciting for the sector and really broadening the investor base for companies operating in life sciences. But ultimately, what does this mean for real estate? Well, the clustering of all these innovations is already happening across campuses. The major impact of this rapid change now is the need for flexible space that occupiers can take, and it's got to cater for so many different types of uses. And we'll come on to that in a minute, but a lot of these uses might not even exist today. And this is what we're responding to as a business through our, particularly through our asset management activities. So next slide, please, Richard. Thanks very much. So when it comes to the real estate supporting life sciences, it can take many different forms, and this really depends on each occupier's business model. We still have traditional offices in the sector. I mean, scientists call it write-up space. It's still a big requirement. We have wet labs, which is where scientists can manipulate liquids, biological matter, chemicals. We have dry labs, which is space really focused on computers, physics, and engineering. And then other forms of real estate now relevant to the sector include data centers and production. I think production is really interesting. It's become, again, on the rise over the last few years, particularly post the pandemic and post Brexit, as more and more organizations now are seeking supply chain security for important drugs, for R&D, and that all became very apparent, both, as I say, post Brexit and during the pandemic. So a lot of businesses are now looking to relocate production back into the UK, which is really interesting opportunity for us. All these types of uses fall under the real estate umbrella of life sciences. And you can have companies that have all of these uses under one roof. And in our portfolio, we're trying to create the right sort of flexible space in the right locations to cater for these modern occupiers. Next slide. Thank you, Richard. On this slide, I'm trying to set out exactly how we're investing our capital to create value for our shareholders. And we've deliberately assembled a portfolio with opportunities to deliver space for science and technology, either through ground up development, such as what we're doing at Oxford Technology Park, and I'll come on to that in a minute. We're repurposing space for laboratories and other science and tech uses in Cambridge and in London. And the cost of this obviously varies depending on the type of building and the scale of the scheme and the level of repurposing that's required. But generally, in terms of the upside, fully fitted laboratory space can achieve rental premiums of between 70 and up to 100% over traditional offices in these locations. And laboratory space is also being valued on a tighter capitalization yield, and that premium is around 75 basis points. So thus we're seeing enhanced rental levels and enhanced multipliers on our values, and all of that will be driving long-term capital growth and earnings growth. The next slide gives you a brief snapshot of the portfolio. I'm not going to wade through all the detail here, but we have 5 assets now, spread across Oxford, Cambridge, and London. Our biggest asset is a ground-up development opportunity at Oxford Technology Park, where we're developing nearly 500,000 square feet of laboratory and production space. And you can see here some of the key portfolio stats. Our contracted rent is £15 million, but the ERV of the existing portfolio is nearly £20 million. So real headroom for rental growth there, and there's plenty of upside to come through further development and further repurposing of space. Interestingly, our occupier base on the next slide is dramatically changing as well. We do have sort of legacy occupiers, non-life science businesses, but what we're doing as we repurpose and redevelop is driving up the percentage of life science businesses within the portfolio. So that's now increased to over 50% with new lettings to companies like Beacon Therapeutics and Syncona, Oxford Gene Technologies, and Fortescue WAE as well. Interestingly, we had 100% rent collection last year. We had not a pound of irrecoverable rent, and I think that really demonstrates the strength of the sector, but also demonstrates the strength of our underwriting. You know, when we're leasing to businesses, we spend an awful lot of time. We have two in-house scientists in our small team who spend all their time researching prospective occupiers, underwriting their business plans, looking at their cash flow models, looking at the science, looking at their funding, to really make sure that we're backing the next winners here and providing space for companies that are in a real growth trajectory. So very briefly, just want to get our hands dirty, if you like, on the real estate, because this is the nub of the business, obviously. Oxford Technology Park is a 20-acre campus with about 500,000 square feet of life science space planned, just north of Oxford, 7 miles north of the city centre, and very importantly, adjacent to Begbrook Science Park, which is one of the university's main incubators. Begbrook is actually full, it's expanding rapidly, and many of the smaller startups and growing businesses move on from Begbrook, and we were a natural home for them as they mature and look to establish their own independence. And what we provide on Oxford Tech Park is a range of buildings from 6,000 square feet all the way up to 50,000 square feet, where businesses can move in, they can grow, and they can hopefully have sort of cradle to grave facilities on the park. We're now 66% occupied. We've got more space to build out. You can see here a number of buildings are still under construction. But this leasing activity, where we've added over £3 million of rent just in the last 12 months, we've seen rents grow by over 30% here since we acquired the park back in May 2022. So in less than 2 years, we've seen that sort of level of rental growth. And this space is still very affordable. It's relatively cheap to build. We build these large tech boxes, which are large 2-story flexible buildings that can house labs, offices, R&D space. They have plenty of power. They have enhanced power supplies. They have PV panels. It's a very green scheme, and it's proving very popular with the occupier market. And we are seeing, interestingly, a lot of AI, quantum, and robotics businesses starting to cluster at the park, all of which have sort of life science related uses. Very briefly, moving on to our flagship London asset at Rolling Stock Yard, just on the edge of the Knowledge Quarter. Most recent deal here was to a Syncona-owned startup called Beacon Therapeutics. And what we've done here is repurpose traditional office space, which could be let at £60–65 a square foot, into fully fitted laboratory space. And we set a record rent for London lab space in this building at £110 a square foot. Obviously, a significant premium over traditional office space. Not every building converts to labs. I think there's a lot of publicity around, you know, every vacant Debenhams department store in the UK being repurposed. Not every building works. In fact, many don't. You've got to have power. You've got to have the right configuration of the building. There's a lot of factors that go into underwriting these buildings prior to acquisition and prior to conversion. And we've got a very small team, but some really good consultants we work with to help us underwrite these assets. And then finally, Camber Park, which is on the outskirts, 7 miles west of Cambridge. It's perhaps the asset with the biggest long-term value add in the portfolio, actually. It's about 250,000 square feet. We already have some great science and technology businesses like Carl Zeiss and MTK. We rebranded the park, and subsequently we've completed our first laboratory letting to an agri-tech company. But the wider opportunity here is to actually convert vacant office space, or soon to be vacant office space, to laboratories. And we have about 80,000 square feet of this coming available for conversion by the end of 2025. Now, the basic values here, to keep it simple, are the assets as offices are valued at about £350 per square foot capital value. We will spend on an average £250 a square foot of capital expenditure to fully fit that space with laboratories, upgrade the power, upgrade the amenities. So an all-in cost of £600. But the end out value of these, when they're leased as labs and capitalised by the valuers, is closer to £900 a square foot. That's a significant margin on the additional capital expenditure. And we'll be rolling this fit out across Camber Park over the next few years. Cambridge has a chronic undersupply of space. There's over 1 million square feet of demand for labs at the moment. Currently available about 100,000 square feet. There is some supply in the pipeline, but given what's been happening in the financial markets over the last sort of 18 months, particularly, a number of those schemes have been mothballed. Developers are struggling to get development financing, and are struggling to commit to speculative ground-up development. We've got buildings here that we can bring to the market very quickly. They're up and built, the fit-out's commencing, and we will be looking to drive rental levels on this to over £50 a square foot. Still a significant discount to the prime Cambridge laboratory rents, which are now in the mid-70s. So we're well positioned for future growth, and despite the wider macro uncertainty over the last couple of years, we've continued to focus on our asset management initiatives, which will drive rental growth and earnings. Now, over the longer term, we expect more and more of our portfolio to benefit from the rent and yield premium that I've demonstrated earlier, that life science space is achieving in the short term, and we'd expect interest rates and valuation yields to further stabilise now. I think we've got real visibility now on where rates are peaking out. And that will in turn provide visibility on where valuation yields are peaking out in the UK real estate market. We're beginning to see some liquidity return to the real estate capital markets. Overseas investors getting on planes, coming to London, coming to the major cities, looking at opportunities to invest in the UK. I think all of that will be beneficial to underpinning values and seeing further earnings and capital value growth. But it's really important as a business that we maintain our discipline around capital allocation, shore up our balance sheet, make sure we've got the capital to deliver on these projects, and provide a best-in-class portfolio here for both our investors and really importantly for these sort of growth businesses within what is a really exciting growth sector in the UK real estate world. So that really concludes my sort of summary of the business, and hopefully it's given you a flavour of the sort of projects that we've got underway in the portfolio.
Yeah, great, Simon. That was really good. Questions have begun coming in thick and fast, so we'll crack straight into them because I'm conscious of the time. I'll try and group some of them up. So obviously there's a lot of office space that you're converting into lab space. What is the valuation differential between the two?
Yeah, it's a good question. I mean, just to take, obviously some markets slightly different, but broadly, the valuation is about 100. It's between 75 and 150 basis points on the valuation yield, on the multiplier, if you like. So a really prime laboratory building in Cambridge will be valued in about 5.5% cap rate, maybe even closer to 5%. Whereas offices at the moment, our offices are valued in between sort of 7 and 7.5%. So there is a fairly significant yield compression there, and that's driven by prospects for growth. I mean, you know, we're seeing rents move, but in our view and in the market's view, there's still, you know, a really good headroom for further rental growth.
Yeah, and a couple of questions on fitting out or refurbing the office space into lab space. What I think you ran through an example in your presentation, but what is the sort of the average cost of refurbing that space, and what is the sort of premium or return on that you get at the end?
Sure. I mean, it varies. I mean, the two examples I can give is at Oxford Technology Park, where we're fitting out the sort of shell units with they already have new air conditioning in there. They already have all the M&E, as we call it. That's costing between £100 and £120 a square foot to put fitted labs in there, capital expenditure. But in return for that, we're taking rents from £22 a square foot to the most recent letting we've done at 45. So we're more than doubling rents for about £100 of capex. At Camber, slightly different. They're older buildings. They require a lot more of the sort of air conditioning, the M&E to be upgraded. We're probably going to spend on average about £250 a foot there. But again, we're doubling the rents from low 20s to 50 plus. So the payback is reasonably swift, but also we're seeing significant, as I say earlier, yield compression, which gives us that sort of double whammy, if you like. We get the rental uplift and the capital value uplift.
No, that's interesting. So what's the occupancy of the portfolio at the moment, and what is the yearly churn on the space?
Yeah, the occupancy at the moment is about 79%. It was slightly down on last year because we actually delivered more space at Oxford Tech Park. So on a like for like basis over the 12 months, we actually went from about 80% to 85%. But because we built more space, the actual overall occupancy was down slightly to just about 79%. That's fine. I mean, we are creating space for science, and to have occupancy is an opportunity for us. We need new lettings, obviously, to drive the rental growth. What we don't want are a lot of long leases with sort of RPI indexed income, because that, in our view, and what's proven in the market, is that rents are growing faster than inflation. So we want a reasonable level of structural vacancy within the portfolio.
Yeah.
I mean, on a stabilized portfolio, that would probably be a vacancy rate of between 5 and 10%. So we've got a bit more to go there.
Yeah. Yeah. So a couple of questions are coming about how you're going to sort of grow the business. And I know you mentioned in your annual results that you were looking at sort of JVs or co-investments as a way forward. Can you talk a bit more about that?
Yeah, absolutely. I mean, obviously, we're not going to dilute our shareholders raising money at discounts to NAV. I mean, there have been a few, obviously, in the real estate sector recently where people have been trading at relatively small discounts. And if you do that and you've got a plan for the capital, then I think that does make sense if it's accretive. But what we would look at, I mean, to be clear, at the moment, we're rolling our sleeves up and really focusing on delivering on the assets that we acquired at post IPO. I mean, that's absolute focus. But if to grow the business further, would we look at strategic joint ventures? Absolutely. And we've got some really interesting assets in our portfolio. These are assets that took a lot of time to piece together off market. And they're assets that are sought after by investors. But there's a lot of capital looking at the sector. You probably saw recently that British Land announced the joint venture in London with Royal London. Now that's exactly the sort of thing, yes, the sector should be doing. If we can't raise money through the public markets, then there is a significant amount of private capital, whether it's people like Royal London or the big Australian superannuation funds or Canadian funds, who are looking to access the sector. But we would only do it if it was an accretive opportunity for our existing shareholders. So whether that's selling a stake in an asset and redeploying our share of that capital with a partner into a new, more accretive asset that we can find in the market or off market, that's something we would obviously look at, but only if it worked for our shareholders.
Yeah. Question here on the occupiers, and the life science startups. So what is the sort of normal failure success rate of a life science startup? And additional question on how strong the sort of venture capital market is for this sector.
Yeah, good. Two good questions. It's I don't have any stats on the failure rate for sort of startups. Most of the businesses we've got coming into our portfolio are sort of second phase funded businesses. So if you look at our most recent deal at Oxford Tech Park, big deal was with a company called Oxford Ionics, backed by Oxford Science Enterprise, which is the university's investment fund, and we have a guarantee on that lease from the university's investment fund. So we're very, very careful looking at the covenant strength, the financial strength of occupiers. We've got Beacon Therapeutics come into our London property. They're owned by Syncona, who are obviously a well-established investment trust. So we don't have what I would call a lot of real startup risk, but we have two scientists in our team. As I say, we have a small team. We have two full-time well-qualified scientists who spend their time looking through to prospective occupiers, running through their business plans, their models, running through the science with them, looking at who's funding them, who's backing them, and working with us as a team to sort of help deploy effectively our capital into investing in the real estate for these companies. So we spend a lot of time looking at them. In terms of VC funding, it stabilised last year into life sciences at around £2 billion. That was down from the peak during the COVID years of about 2.5. UK VC investment, I'm told, last year was down about 43% across the whole of the UK market. Life sciences was broadly flat. Life sciences was only down 6%. So I think that gives you an indication of the sort of attractiveness of this particular sector to VC and that sort of investment community.
Yeah, yeah, that's interesting. We've got a question here which is specific to Oxford Technology Park, but I think could roll out across the whole portfolio. So obviously you spend money on fitting out the lab spaces, and with the leases that you then bring in, maybe they have a break option after 5 years. What do you do to sort of protect yourself if that break option is exercised in your costs and things like that?
It varies. Some of them do have breaks at year 5. It varies enormously. I mean, we're not adverse to that. I mean, it gives us an opportunity. If we view rents are going to continue growing, it gives us an opportunity then at that time to capture a new higher rent. I think there are a number of factors peculiar to this sector. First off, they're quite sticky occupiers. What we find with life science businesses and high tech businesses is they don't like moving. It's really disruptive. We're talking to one occupier at the moment. He says it's going to take them 12 months to wind down their scientific processes to the point where they can safely move the business into our building, and that's fine. We can work with them on that. So once they're in, they tend to stay, and often they will take more space than they need day one because they're happy to pay a little bit more for space that they can then grow into. With the view that they don't want to have to move in 3 or 5 years' time. And we've got the sort of space and the sort of structures that we can provide that sort of flexibility for them, which is absolutely key. We build in sometimes penalties, so they pay a rent penalty if they exercise the break, but also on the fully fitted spaces, that's our equipment. So if they do move, we keep it. They have to pay to sort of bring it back up to an occupational standard, and then we can relet that space with all the equipment as is. So actually, it's not a big hit. We look at least a 10-year life cycle now for these units.
Yeah, no, that's good. A lot of questions here on the debt. I don't know, just want to run through sort of the debt profile.
Sure.
When that matures, what the cost is on that and things like that.
Yeah. Oh, absolutely. Our current loan to value at year end is just under 25%. Our target range has always been 30 to 40%. And we refinanced the business back in May with HSBC and Bank of Ireland. That facility runs through to the middle of 2026. And then we have 2 one-year extensions on the back of that. We're fully hedged now until the middle of 2025. And we're actually forward hedging. So as we draw debt down for whether it's for capital expenditure, we have bought forward caps, if you like, to make sure that we're locked in. So we're slightly over hedged at the moment. I think we're about 106% hedged on our debt, which is fine. We've actually got some really good swaps in place on the bulk of the term loan as well. So we've got 2 very supportive lending banks. They totally get the business. They understand what we're doing. As I say, with 100% rent collection, we've obviously got great cover. So we're in a good place there.
Yeah, good. Question here, and I think we've talked about this recently. What's behind the share price weakness in recent months? It seems that we've been making good progress on lettings, but the share price seems to just keep going down. What's your view on that?
Yeah, frustrating. Obviously, as a team, we've been buyers. Post results. I think there are a number of factors. I think obviously the REIT sector as a whole has suffered. I think people have been waiting for visibility on where valuations have fallen. Our fall in NAV at year end actually was one of the. If you look at the actual underlying fall in the value of the portfolio, that was really the only assets that fell in value were ones that are still valued as offices where we haven't got stuck in and converted to laboratories yet. And actually, when you benchmark the fall in value against the indices and our contemporaries, we were actually one of the best performers. So it's frustrating. I think we're a small stock, and the shareholder base is quite quite tight at the top end. We've had one or two multi-managers who have been selling out of REITs generally, which has had an impact. But you know, we don't see any correlation between the share price and what's happening operationally and within the portfolio. You know, we just got to be patient.
Yeah, good. We've had a couple of questions on how do the directors and does the management team own shares in the company? I think you just mentioned it there that you brought some.
Correct. Yeah, the management team, Ironstone. I mean, we bought 3 million shares, over 3 million shares at IPO, which we still hold. We've all been buying through the last 2 years. The Ironstone Asset Management itself as an entity now has over, I think, over 1 million shares, which we buy on a sort of quarterly basis. So we're well vested in the company, and post results, the team have been buyers. So we strongly believe in the thesis, and as I say, we don't see any correlation at the moment between the share price and the underlying portfolio.
Question on dividend. You obviously cut that recently. Is that now at a more sustainable level going forward, and do you hope to grow that in years to come?
Absolutely, yeah. I mean, it was a decision that the board didn't take lightly, and you know, this was something that when you looked at the share price, you looked at what we want to do with the capital that the business generates. You know, hopefully I've demonstrated by talking you through some of the projects how accretive this process is by converting and leasing to as a laboratory space, both from an earnings perspective and a value perspective. So what we're saying is at the moment, you know, that 2p is rebased now. It's covered. Future dividends will, you know, going to be at that sustainable level, and they will reflect the progression in underlying earnings, and the underlying earnings will be driven by our leasing up of the space that we're building and developing. So we see this very much as a one-off rebase, and from here, hopefully, we're looking forward.
Yeah. Well, 12 o'clock now, but I think I'll leave it on. It's a bit of a statement rather than a question, but I'll get your thoughts on it. The worry is that the business will be taken out at a big discount, a bit like some of the other REITs. Is that a worry for you?
I say a worry. We can't do anything about that, Jen. I mean, we're focused, 100% focused on what we do around the portfolio, and you know, I think every REIT or every business trading at a discount is possibly vulnerable, but as I say, that's not our decision. That's something for our shareholders and our board to decide. So, you know, as things stand, we just carry on doing the best we can on the portfolio.
Yeah. Great. Okay. Well, yeah. Thanks a lot for coming on and discussing all of that. And it was really interesting. And we'll see how it goes going forward.
Good to speak to you again. Thanks, Richard.
Thanks.
Thanks, Richard. I'll just do the sort of end bit, if I may. So thank you very much again, Simon. That was great. We'll be back next week talking to JP Morgan Global Core Real Assets, JARA. And as usual, we've got a full lineup of things. We are sorting out what's going on the 3rd of May. We did have UK commercial property, which may not exist by then. So I think we're looking for somebody else, but we'll let you know what happens. But thanks again for tuning in this week, and have a good weekend, and we'll see you next Friday. Thanks. Bye-bye.